Well, let's go and get to today's guest. Anthony Murphy from Lucerne Investment Partners is standing by to get his take about how to go and play these tricky markets. Anthony, welcome back to the program. It's been a while and it's good to go and see you there. Want to start by asking you about the dangers of following the herd at the moment, because what we're seeing are these big wild swings and euphoria, then extreme pessimism on one side, but doesn't really always generate alpha for your portfolio.
Yeah, thanks for having us, David, and it's good to be back on the show. Yeah, I think you just have an interesting chart up there and graph regarding interest rate hikes and what the market probably wanted to believe, which resonates with herd mentality. The market wanted to feel that there would be this gradual interest rate hike program, but we all know that was left too late, and as a result, central banks around the world have had to play catch up. So the herd wanted to believe that market's going to remain quite buoyant and optimistic, but that obviously hasn't remained the case given the amount of stimulus that's been pumped into the system post-COVID in particular. And I think, if you look at the last 2 years, the hubris behaviour that we've had, firstly in the buy now, pay later space, and the fallout that we've now seen from that with the smaller players in that space. And obviously the most recent example since we've last spoken has been the collapse of FTX on a global basis, which has even surprised many large institutional investors that claim to have done an extensive amount of due diligence on Sam Bankman-Fried and his associated companies, and how wrong they could have been. And so we just say to investors just to be cautious, particularly in these markets, and we think rational thinking is incredibly important as we really face an unknown future for financial markets, particularly going into 2023.
Anthony, how much is that collapse of FTX and other examples we're seeing where we've seen some pretty notable failures at the moment that's going around the crypto space, the damage it's done to it longer term? Because everyone can see where the technology is moving towards, but at the same time, there are so many inherent risks out there trying to invest in that space. If you want to go and try and put your portfolio aligned with that future, how do you go and do it without taking an extreme amount of risk?
Yeah, and I think, look, David, hindsight's a wonderful thing when it comes to investing, and as I've said previously, we're all billionaires in hindsight, but I think it really comes down to rational thinking. The world wanted to believe that a 30-year-old that claimed to have a philanthropic heart, he was going to give away his billions of dollars in fortune to charity, and they wanted to believe in that story. But then when rationality comes back into an investor's psyche, you'll see that it's no surprise in our opinion that sector has failed, that business has failed. However, in saying that, I do believe it's actually a good thing, the digital asset space, that when you see a market or an asset class like this emerging at such a fast pace, you have retail or individual investors tend to do well initially. You then have the institutional market follow, and now you have regulators. And that's what you're actually starting to see in the digital asset space, that regulators are stepping in and taking charge. And we actually encourage that behaviour and momentum. I think in the digital asset space, though, Web 3.0 is real, i.e. the internet of tomorrow. And so at the moment, we do have exposure for our investors in the Web 3.0 space, but we're investing in strategies that are actually investing in the infrastructure and architecture that supports that thematic going forward. And there is real genuine stakeholders out there, like companies such as MasterCard and governments around the world getting behind the Web 3.0 thematic. And that's our preferred exposure to the space right here, right now.
Anthony, can I go and prize in a little bit at this point and go and get some more detail about the kind of ventures you're putting your money into when it comes to the infrastructure side of the equation?
Yeah, sure. So there's a fund in particular based in Australia called Primal Capital. It's a very small fund, which we tend to take a bias towards because of the flexibility that comes with a smaller, more nimble manager. Primal Capital, we started our work on them in late 2021. We liked that they were going into the seed and pre-seed space of that market and investing really in the tangible assets that are supporting the digital asset space. And investors, as a result of being in that part of the market, have actually realised quite substantial positive returns in the early days. So whilst you've had this huge dislocation going on in FTX and other pockets of the crypto market like Terra, these actual real tangible assets within that space that are investing in infrastructure, that are partnering with MasterCard, that are partnering with governments around the world. Whereas, these companies do realise the world is going that way, and they want to partner with respective emerging players within that space. And so we think Primal Capital is a really good example of where investors will do well over the next 3 to 5 years from investing in the digital asset space.
Anthony, outside of the digital asset space, what are some of the other areas you feel comfortable investing in at this point in time? Because we've got a very, very uncertain investment backdrop, still high inflation, high interest rates, expectations we'll see even higher interest rates next year. Where are you going to put your dough in such a tricky environment?
Yeah, so it's not all doom and gloom, I think, in a rising interest rate environment. For traditional asset classes such as, equities and properties and bonds to some respect, a rising interest rate environment isn't a fantastic hunting ground. And why is that? Because companies borrow to invest in their businesses to grow. So when the cost of that borrowing increases from 2 to 5 to 6 to 8%, that obviously has an effect on their top and bottom line. And then when you combine that with wage inflation, it's not a pretty melting pot. However, there are some investment strategies out there in asset classes that do benefit from this rising rate environment. I mean, if you just look at the term deposit market, 12 months ago, one would be getting 70 basis points on a term deposit, and now one can receive sort of 3% plus. So the opportunity cost of holding cash is not as great as it was previously. However, there is an asset class that we really do like at the moment within the property space. And that's not direct exposure in property. I think the Goldilocks years for property investment in Australia have now passed us. I think one has to be very selective and opportunistic when they're considering direct exposure to property. But one strategy with exposure to property we do like at the moment is the non-bank lending space, where investors, because of this rising interest rate environment, can realise annualised returns of 8 to 10% per annum to take a fully secured position against tier one property assets in this country. And I mean in cities such as Sydney, Brisbane, Adelaide, Canberra, Melbourne. We're seeing fantastic opportunities where investors are realising up to 10% per annum with regular income coming into their portfolios and taking a secured position against an asset of 65% LVR, which gives them plenty of cushion if there is actually a correction in property valuations. So when you consider that as an investor, one probably over time, depending on one's profile, wants to make 6 to 12% per annum. Equity markets have delivered 30% per annum. Have delivered 8% per annum over the last 30 years. Is that going to continue given all the stimulus and support that we've had? Probably not over the next 5 to 10 years. Property's also gone on a bit of a Goldilocks run. So if one can generate 8 to 10% per annum over the next 3 to 5 years, fully secured, in defensive assets, I think that is something that should be at the forefront of all investors' minds.
When you talk about tier one properties, what kind of properties are you referring to there?
Yeah, so I'll give you an example. There's an asset in Canberra that we looked at. We really like Canberra as a market. It's quite insular with the public service exposure up there, the public sector as a whole. So right in the centre of Canberra, near Woden Plaza, we found an asset recently that we could land bank for investors. They're building an apartment complex there of 300 apartments, but we're just taking the risk on the land initially, David. So we effectively land bank that asset for 12 months, and then we pass that on to construction financing to another group that's already secured. So I ask investors that, do they believe that the Canberra property market would hold up over the next 12 months? It might contract, but is it going to contract by 35 or 40%? I don't believe so. So you take a full security over that asset with company and personal guarantees, and you're making an 8 to 10% yield per annum, and you're realising that monthly in income interest payments. Other assets include growth corridors in Melbourne's west, southwest of Brisbane as well, and even the north shore of Sydney. So you're not having to go to opaque areas around Australia to realise these sort of high quality returns. And we would encourage investors to stick to land banking and initial civil works, so 9 to 12 month loans. We don't feel that one needs to take risk in the construction sector at the moment, particularly with all the collapses that you've seen with ProBuild, etc., over this last 12 months. And we believe there's plenty more collapses that are going to come, unfortunately, from builders and developers as they face margin squeeze.
Anthony, you asked my final question. I was going to go and ask you there, but yeah, it looks like it's going to be pretty difficult for any of those construction firms out there at the moment, given the high inflation, high cost environment we find ourselves in with falling prices. We've got to leave it there, but thanks so much for joining us here on the program. Always great to chat as always. We'll speak soon.
Thanks for your time, David. Appreciate it.